Welcome to Asset Insights. Today we're taking a measured, fact-based look at Bitcoin, what it is not, and what's actually been driving recent market volatility. We'll also address some misinformation that's been circulating online, including claims linking Bitcoin's creation to Jeffrey Epstein, and then break down what's really happening beneath the surface of the current market pullback. This is not a price prediction video. This is context. Bitcoin was introduced in 2008 in the aftermath of the global financial crisis through a white paper published under the pseudonym Satoshi Nakamoto. At its core, Bitcoin is a decentralized monetary network. No central issuer, no central authority, no ability for any single party to alter supply. Transactions are recorded on a public blockchain, a distributed ledger maintained by thousands of independent nodes across the world. Bitcoin's defining characteristic is scarcity. Maximum supply, 21 million, issuance schedule, fixed and transparent, monetary policy, immutable. This is why Bitcoin is often compared to gold, not because it behaves like gold in the short term, but because it shares the properties of scarcity, neutrality, and resistance to debasement. Over time, Bitcoin has evolved from an experimental technology into a globally recognized financial asset. It's held by public companies, integrated into regulated investment products, and adopted by nation-states as legal tender. Whether you personally hold it or not, Bitcoin is now part of the global financial landscape. Recently, claims have resurfaced online suggesting that Jeffrey Epstein was involved in the creation of Bitcoin, or was, in fact, Satoshi Nakamoto. Let's be absolutely clear, there is no credible evidence supporting this. The rumors largely originate from fabricated or altered emails, screenshots taken out of context, speculation amplified on social media. A review of the Epstein-related documents released publicly shows no verified communication linking him to Bitcoin's creation, its early codebase, or its initial mining activity. There are no known wallet addresses, code contributions, early transactions, or technical fingerprints connecting Epstein to Bitcoin's origin. While Epstein donated to academic institutions that later conducted blockchain research, this does not imply authorship, control, or involvement in Bitcoin's design. Bitcoin's creator remains unknown. The Epstein narrative is misinformation, not analysis. Now let's talk about the recent market movement. Bitcoin recently fell from cycle highs above $120,000 to lows of under $60,000 before stabilizing. This was not caused by a single event. It was the result of liquidity conditions. Key factors: reduced global risk appetite, tighter financial conditions, falling trading volumes, and lower market maker depth. When liquidity thins, price movements become exaggerated. Small sell orders cause outsized moves, particularly during low-volume periods such as weekends. At the same time, leverage across the crypto market was elevated. As prices fell, forced liquidations triggered, stop losses cascaded, weak positions were removed. This is not unusual in Bitcoin cycles. It is how excess leverage gets flushed. A significant number of retail traders entered the market late in the cycle, often using leverage. When price moved against them, liquidation followed. This process is often referred to as capitulation, not because Bitcoin is failing, but because speculative positioning is being unwound. Historically, these phases reduce volatility over time, strengthen holder distribution, reset funding rates, improve long-term structure. Bitcoin is not behaving like digital gold day to day. It is behaving like a global liquidity instrument. That distinction matters. Despite price volatility, on-chain data suggests something important. Accumulation has resumed. Long-term holders are increasing exposure. Smaller wallets are re-entering, and sell pressure is declining. This does not mean price immediately goes higher. It means ownership is shifting from weak hands to strong hands. That process takes time. If key support levels fail, further downside is possible. If they hold, consolidation may follow. Either way, volatility is a feature, not a flaw. Bitcoin has experienced multiple drawdowns exceeding 70% throughout its history. Each time it was declared finished. Each time it continued. This does not guarantee future performance. It does, however, highlight one thing. Bitcoin is not driven by headlines. It is driven by structure, liquidity, and conviction. Ignore conspiracy. Ignore emotion. Focus on data. As always, this is not financial advice. Our content is to educate you on crypto projects. Always do your own research. Risk only what you can afford to lose. Your money is your own, so be wise with what you do with it. crypto is a highly volatile environment and you can lose all you invest. If you enjoyed this video and want to see more, please click subscribe and turn on notifications. Feel free to drop a comment below and let us know which crypto project you would like us to cover. Thanks for watching.